Hello, I'm Juan Espinosa and I'm a Master's of Science in Finance candidate at the University of Notre Dame.
Hi, I'm Raj Patel and I'm a Master of Science in Finance candidate at the University of Notre Dame.
Hi, my name is Barragan and I'm a Master's of Science in Finance student at the University of Notre Dame.
Hi, my name is Nicolas Muglia and I'm a Master's of Science in Finance student at the University of Notre Dame.
Hey guys, my name is Ashwin. I'm also an MSF student here at Notre Dame. We're super excited to be doing this GSU business valuation competition, and here's a proposal. Welcome to our valuation report.
To begin, we will be conducting a company overview. The purpose of our report is to determine the fair market value of a 51% equity stake of the company as of March 1st, 2024. This is going to help with corporate planning, including a potential sale, merger, or a recapitalization, and it helps provide a basis for internal decision-making and future succession planning among family shareholders. This will help align management and ownership around the company's strategic direction and long-term growth goals. A quick overview of the company's history, as they were established as a family-owned and operated business in Texas in the late 1970s, and initially served only the oil and gas industry. Moving into the early 2010s, they were able to open 2 retail storefronts in Texas, and they were able to help move their corporate headquarters to a larger facility, which helped streamline operations and structure, such as adding in-house embroidery later on in the 2010s, and also being able to launch their own e-commerce platform. This allowed them to strengthen their company enough that they were able to diversify their customer base into construction. And as you can see, post-pandemic, they were able to invest in a website revamp and continued expansion into new Texas markets, as seen as maybe a effect from the downturn in brick and mortar sales during the pandemic.
As for the business overview, the company generates most of its revenue, about 60%, from the oil and gas industry, driven by demand for workwear, PPE, and large-scale uniform programs. The remaining 40% comes from electric utilities, where it supplies flame-resistant gear and safety apparel. Together, these sectors highlight a strong presence in essential, safety-focused markets with consistent, recurring demand.
The company's organizational structure is designed for clarity, accountability, and speed. The CEO and president oversee a well-connected framework linking operations, sales, IT, and HR, which keeps communication centralized but efficient. This structure ensures teams stay aligned, minimizes overlap, and allows leadership to stay focused on executing strategy and driving results.
Our shareholder structure is very simple for the company. The business is family-owned with 3 separate shareholders, A, B, and C. A holding 50% or 500 shares, B holding 100 shares or 10%, and C holding 400 shares or 40%. Because no shareholder currently holds more than 50%, control is technically shared. That's why our valuation is focusing on a 51% equity stake, acquiring our level of ownership, which would provide a controlling interest. As if you bought less than 51%, you'd have to factor in a minority discount, as they wouldn't be able to assume any key direct business decisions.
The company employs 169 people across multiple divisions, with production representing the largest group at 60 employees, focused on in-house customization and embroidery. Warehouse operations account for 28 employees managing storage and fulfillment, while HR, retail, and IT collectively support daily operations and staffing. Management and customer service teams ensure coordination and client satisfaction, supported by smaller departments like accounting, program support, and purchasing. Overall, this structure highlights a balanced organization designed for efficient production and responsive service delivery.
This slide is going over our customer analysis, which is going to highlight 2 key insights. The first of which is that a large portion of our customers are reoccurring, which is positive as it reflects strong loyalty and satisfaction. But this also leads to a downside, which is growing customer concentration risk. As shown in the chart, the top 10 clients account for an increasing share of total revenue year over year, meaning the business is becoming more reliant on a small group of customers every single year.
In our second section, we will be going in depth on the PPE market. We will be doing a broad market overview, look at the competitors as well as the drivers, and analyze the future outlook for the industry. The North American PPE market is growing steadily, from about $29.6 billion in 2024 to over $42 billion by 2032, resulting in a 4.6% compound annual growth rate. This growth is being driven by stricter OSHA enforcement, reshoring production, and ongoing investments in workplace safety. Even as the industry matures, the demand for reliable, high-quality PPE remains strong, especially across construction, manufacturing, and healthcare. We've reflected the steady growth in our valuation, which supports a stable, sustainable outlook for the industry. This slide breaks down the PPE market by product category to show where most of the demand comes from. Hand protection leads the market at about 24%, driven by its everyday use across manufacturing, healthcare, and construction. Protective clothing follows closely at around 23%, while respiratory and footwear protection have grown steadily as safety standards tightened after the pandemic. Smaller segments like head and fall protection remain niche, but still essential for compliance. Overall, this breakdown helps highlight where the strongest demand and potential for innovation lie, especially in high-volume categories tied to regulation and consistent replacement cycles. Continuing on from the market outlook section, the PPE market is competitive but dynamic. Regulations like OSHA and EU standards create some barriers to entry, yet low-cost manufacturers still find ways into basic product areas. Suppliers have decent leverage since materials like nitrile are concentrated among a few players, and large institutional buyers such as hospitals and government agencies can push for lower prices. Substitutes aren't a major threat since PPE is legally required, but rivalry remains intense, which keeps pricing tight and innovation constant. In short, success in this space depends on managing costs, staying compliant, and standing out through quality and technological differentiation.
We will now address historical financials provided by management and some assumptions we made relating to future valuation. Let's begin by looking at our foundation, the balance sheet summary. This slide confirms a consistent trend of growth and strengthening stability. Our total assets have grown to $20.4 million in 2023 and have maintained a high liquidity structure. Current assets in any given year make up 80 to 90% of our total. Driven by strong receivables, we are provided with excellent short-term reserves. On the financing side, we have an equity-driven structure. The growth is fueled by retained earnings, which rose to $11.2 million. This reflects retained profitability and confirms a conservative, low-risk capital structure that we actively rely less on long-term debt. As a whole, the firm is expanding while maintaining a high liquidity and conservatively financing growth through retained profits. The income statement summary highlights our performance with a specific focus on 2020 as an anomaly and subsequent cost management. We saw strong revenue growth rebound from the 2020 low to a projected $58.2 million in 2023. To specifically address 2020 with a negative 1.6 EBITDA, this was covered by a $1.9 million gain in other income and expenses, primarily supported by the Paycheck Protection Program. This non-operating income was critical as it temporarily boosted liquidity and allowed us to cover certain payroll and operating costs during the COVID-19 pandemic. Following this period, a key driver of the gains was cost control. Looking at salary expenses, $7.8 million in 2020, this was reduced to $5.7 million in salaries for 2021. This reduction was essential in stabilizing the business and allowing it to maintain profitability. This chart visually tells the story of our recovery mentioned in the prior slide. Revenue here via the bar chart and EBITDA represented in the gold line clearly shows the 2020 drop. Revenue hitting a relative low of $33.2 million and EBITDA plunging to a negative $1.6 million in operational loss. Since then, though, the company has staged a powerful recovery. Crucially, the actual EBITDA performance is tracked above the dotted line. This proving the recovery is not just exceptional, but maintained in 2022 and 2023, both having EBITDA margins of 5.0 and 4.7 respectively. Looking ahead, the forecasted revenue and EBITDA chart establishes our path for the next 5 years. The key takeaway is operational stability. The high efficiency we achieved in the past, specifically the 5% margin in 2022 and the 4.7% in 2023, form the basis of this projection. We assume we can hold a midpoint of the EBITDA margins, stabilizing at 4.85% over the next 5 years. This stability drives reliable future growth. We forecast EBITDA to grow consistently from $3.1 million in 2024 to just under $4 million in 2028. Finally, this slide is our confident bridge from the known to the unknown. of 2023 to our first year forecast. We are projecting a strong meeting revenue of $5 million, moving from $58 million to $63 million. We feel this jump is reasonable and healthy considering we saw a larger jump from 22 to 23. This growth is supported by improved margins of 1.44% in gross profit and, most importantly, EBITDA margin being stable, taking up only a fraction of a percent. This validates that our operational stability will be maintained as we scale. As a whole, we're projecting robust revenue growth in 2024 while successfully sustaining the high operational margins earned in 22 and 23.
In this section, we'll be discussing our margin analysis with comparables. Our comparable companies were selected based on alignment with the core business of our case, all focused on uniforms, workwear, and facility services. Vestas, Cintas, and UniFirst each operate within the U.S., providing large-scale uniform rental, customization, and safety programs. VF Corporation was also included for its strong presence in durable workwear through brands like Dickies. Additionally, we limited our selection to U.S. firms to avoid country risk and size discrepancies, ensuring a fair and relevant peer comparison for our analysis.
So now focusing on margins, our company's margins currently trail peer medians, showing room for efficiency gains, but also clear upside potential as we scale. The gross profit margin sits at 36.6%, slightly below the peer median of 43%, highlighting opportunities to optimize pricing and production costs. EBITDA margin of 4.9% sits near the low end of the peer range, showing that larger competitors achieve greater operating leverage. However, a net income margin of 3.3% aligns closely with the median, signaling effective cost and tax control despite our small scale. Now moving on to ratios, our efficiency ratios show moderate performance relative to peers, with some working capital tightening opportunities. Asset turnover at 2.9 times is below the median of 4.1 times, meaning revenue generation per asset can be improved. Receivable days of 61 is slightly above the maximum peer value, suggesting slower collections and a chance to refine credit terms. On the positive side, the inventory days of 60 is well below the median, reflecting efficient inventory management and faster stock turnover.
As previously discussed, Cintas, UniFirst, VF Corporation, and Vestas were selected for their similar business models and market positioning. We can see these peers trade at a range of valuation multiples, with enterprise value to revenue between 0.7x and 7.4x, and enterprise value to EBITDA between 7.2x and 27.2x. Our company, which is headquartered in Texas, is positioned slightly below this group, with an enterprise value and revenue multiple of 0.6x and an enterprise value to EBITDA multiple of 12.9x. This reflects a liquidity discount appropriate for a smaller, privately held firm. Overall, this comparison supports our valuation framework, grounding our assumptions in observable market data while accounting for the company's scale and liquidity profile.
These are a few precedent transactions to help us with showing what would happen if you maybe wanted to buy an equity stake in another company, and the implied EV to EBITDA and EV to revenue values would be for that same transaction. For that same transaction of a bigger conglomerate buying a smaller company to help boost their market share. And I think the most relatable one to us is 3M buying Scott Safety in 2017. This is a very big company that specializes in PP&E, as we all know. I'm sure you're familiar with 3M. Buying a smaller company which also specializes in PPE to help boost their market share. So I think their multiples are very comparable to ours.
Now we will be focusing on valuation. Be starting with the model drivers. The income statement assumptions are based on management projections, which include a steady revenue growth but no additional capex forecasted over the same projection period. This is slightly unrealistic. The balance sheet assumptions are drawn from historical trends, providing a conservative view of operating efficiency. Overall, working capital drivers remain stable, resulting in an average projected NWC as percent of revenue at 19.1%, slightly above the peer benchmark of 16%, indicating some room to improve cash conversion efficiency. WACC. Our WACC of 7.3% reflects a balanced risk-return profile for a mid-market private PPE manufacturer. Cost of equity is around 10.7%, derived from the CAPM and then checked with the build-up method, including a 2% size premium for private company risk. The beta used is the median 5-year beta of the comps. Cost of debt is 4.15% based on a BAA rating and a 1.2% credit spread on top of that, including a moderate financing risk. The assumptions together give us a sound foundation for our DCF valuation. Our WACC and a long-term terminal growth rate of 3% in line with US's GDP growth, we get an enterprise value of 40.7 million. And after subtracting a net debt of negative 1.9 million, we result in a total equity value for the company and shareholders to be $42.71 million, which brings the 51% stake that we were assigned to value to $21.78 million. Whose valuation is more affected by WACC than the terminal growth rate. A 1% change in WACC moves the value roughly by plus or minus 30%, while a 0.5% change in the long-term growth rate shifts it about 20%. Chart compares valuation ranges from the different methods used. Our DCF with size risk gives us value between $19 and $25 million for the 51% stake, while excluding the size premium lifts it up to $24 to $34 million. Market-based multiples, including PE and EV/EBITDA from both comms and transactions, support similar ranges, converging around $70 to $30 million. The weights were assigned based on reliability and relevance, with greater emphasis on the DCF around 50% for its cash flow grounding and a moderate weight on market multiples around 45% for external validation, while PE at around 5% carries limited influence given private company comparability constraints. Overall, the weighted mean implies a fair value of around $23.7 million for the 51% stake. The settlement price for the 51% equity is approximately $24 million. Key price drivers including a recurring client base, participation in a fast-growing market, minimal future capex, and improving EBITDA trends. However, the shareholders should note that the buyers may discount this price on account of two things. A, first being the client concentration, and B, a higher weight and a higher value on size risk. Thank you.